I've spent a lifetime being known as the man who buys businesses, not the man who sits on cash. So when you see me in 2026 sitting on what the headlines call a record cash mountain, you should assume there's a reason. Right now, Berkshire has more cash than at any time in its history. People estimate it at $380, $400 billion more than the market value of many major companies. We've been net sellers of stocks for a dozen quarters in a row, letting that pile build instead of chasing whatever's working this year. To most people, that looks like indecision. To me, it's a deliberate position. Cash, in my mind, is not a permanent investment. I don't wake up thinking, how can I get rich holding cash? Cash is a waiting room. It's what you sit in when the surgery you want isn't available at a sane price. It's also, as I've said in various ways over the years, a kind of call option with no expiration date and no strike price, an option on every asset in the world. It feels uncomfortable to sit there and do nothing, but not as uncomfortable as doing something stupid just because everyone else is busy. So if you're wondering why I'm sitting on record cash in 2026, let me answer that in plain language and then tell you how a small investor can copy the principle, not the number. First, what does this cash pile actually mean? Since the bull market came roaring back in 2023, Berkshire has raised cash from roughly $100 billion to nearly $400 billion. We've sold more stock than we've bought for 12 straight quarters, which is the longest streak of net selling I've had at Berkshire. I'm not doing that because I suddenly fell out of love with owning businesses. I still believe that over time, productive assets, great companies, good real estate, solid infrastructure, beat holding paper money. What's changed is the price the world is asking me to pay for those assets. If the only elephants in the jungle are wildly overpriced, you don't fire the elephant gun just to make noise. You keep the gun loaded and wait. What do I see when I look out at the market? One signal people like to attach my name to is the Buffett Indicator, the ratio of total U.S. stock market value to GDP. It's not a perfect tool, but it gives you a sense of how far public market prices have drifted from the underlying economy. As of late 2025, that ratio has been running around 220, 230%, higher than at any time since records began in the 1970s, and well above levels I've previously called playing with fire. Overlay that with other valuation measures like elevated CAPE ratios, and you get the same message. Future long-term returns from here are likely to be lower, and risk is higher than people think. At the same time, we're living in a world with very high government debt, ongoing debate about how much inflation is acceptable, and a market that's been pulled up by a handful of dominant, richly valued companies. I don't claim to know exactly what stocks will do in 2026 or 2027. I never have. But I do know what it feels like when enthusiasm outruns arithmetic. I felt it in 1999. I felt it in 2007. In both cases, I preferred patience when the crowd preferred performance. That's what this cash is about. I do not see enough large, simple, understandable deals at prices that meet my hurdle rates after adjusting for inflation risk and the possibility of rougher weather ahead. In that situation, doing very little is not cowardice. It's discipline. Now, you're not running Berkshire. You're not trying to put hundreds of billions to work. But the principle behind what I'm doing is absolutely something you can use. Here's how a small investor should react when I'm sitting on record cash. First idea, adjust your cash dial to your opportunity set, not to your feelings. Most people set their cash level based on fear or FOMO. They pile into stocks when everything feels good and hide in cash only after they've been hurt. I do the opposite. When bargains are everywhere, my cash dial goes down as I buy. When bargains are scarce and enthusiasm is high, my cash dial goes up as I quietly sell or refrain from buying. In an environment like early 2026, rich valuations, lots of AI stories, plenty of leverage around, I'm perfectly willing to let cash grow instead of stretching for return. For you, that might mean letting maturing positions roll into TC bills instead of forcing reinvestment, trimming holdings that clearly overshot your estimate of value. Refusing to buy something just because everyone is making money in it. You don't need to be 100% in cash, but you also don't need to be 100% invested just because an allocation model says you should. Second idea, raise your standards, not your risk, when prices are high. When assets are expensive, many investors try to maintain their return targets by reaching for lower quality bonds, loading up on speculative growth, or using leverage to juice results. That is the opposite of what I do. When the world is offering me 3-5% in safe TD bills and 4-6% in reasonably safe bonds, and stocks are priced to deliver maybe mid to single digit returns with big drawdown risk, I don't stretch. I just say, if I can't get my required return safely, I'll sit and wait until I can. For a small investor, copying this means no chasing junk for an extra 2 or 3% yield, no margin loans to keep up with an index at all-time highs, no YOLO concentration in the hottest names just to feel clever. Third idea, use 2026 as a planning year for 2027 and beyond. I don't stare at my cash mountain every morning. I spend my time reading, valuing businesses, and mentally preparing what I want to buy when prices become sensible. You should do the same. Make a list of businesses and funds you truly understand inside your circle of competence that you'd be delighted to own for 10 years. For each, write down an approximate buy zone where the price gives you a comfortable margin of safety and a decent expected return. Keep part of your portfolio in safe liquid assets so that if we do get a 2026, 2027 correction, you have actual buying power, not just good intentions. Your rule can be as simple as this: I will only buy in 2026 what I'd be content holding until 2036 or 2040, and only at prices that make sense without heroic assumptions. That one sentence will save you from a lot of heartache. Let me put it bluntly. I'm sitting on record cash in 2026, not because I've lost faith in the market, but because I refuse to pay crazy prices for ordinary risks. I'm prepared to look wrong in the short term, underperform for a while, and listen to people ask, why don't you just buy the winners? But I've seen this movie before. When the cycle turns, the investor with cash and a watch list gets to write their own ticket. The investor who stayed fully invested in whatever was hot you don't have to copy my billions. You just have to copy my posture. Be willing to hold more cash when bargains are scarce. Be patient enough to let overvaluation burn itself out. Be ready mentally and financially to move when the world finally offers you good businesses at good prices again. If you can do that, then my record cash in 2026 isn't something to fear. It's a reminder of the oldest lesson I know. You don't have to swing at every pitch. You only have to be ready when the right one finally comes down the middle.